Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today, we're diving deep into ST Engineering, one of Singapore's most prominent defense and aerospace giants. DBS just downgraded the stock from buy to hold, despite raising their target price to $7.70. This might sound confusing at first, but there's a fascinating story behind this move that every Singaporean investor needs to understand. ST Engineering has been on an absolute tear this year, surging over 65% year to date. That's the kind of performance that makes headlines and gets retail investors excited. But here's where it gets interesting. DBS analyst Jason Sum isn't downgrading because the company's performing poorly. In fact, it's quite the opposite. The fundamentals are so strong that the stellar performance has essentially priced in all the good news. Let me break down what's really happening here. According to the latest analyst report, ST Engineering's first quarter 2025 revenue was largely in line with expectations, but showed uneven performance across business segments. The defense and public security segment grew at a much faster pace compared to the other major business lines. This isn't just growth for the sake of growth. This is strategic, high-margin business that positions ST Engineering perfectly for the current global environment. Think about what's happening in the world right now. Global defense spending continues to accelerate as countries modernize their military capabilities amid rising geopolitical tensions. Major economies are increasing their defense budgets significantly. This creates a massive addressable market for companies like ST Engineering that specialize in defense technology and engineering solutions. But here's what really stands out about ST Engineering's current position. The company has built substantial earnings visibility through their contract wins and order book strength. When you have significant contracted work lined up, you can sleep well at night knowing where your revenue streams are coming from. This predictability is exactly what institutional investors love to see. The company is also making bold moves for the future. ST Engineering has been expanding their capabilities beyond traditional defense into areas like smart city solutions, cybersecurity, and digital transformation services. Their digital business segment, which includes artificial intelligence analytics, cloud services, and cybersecurity solutions, represents a growing portion of their revenue mix. This isn't just about traditional defense anymore. ST Engineering is positioning itself at the intersection of defense, technology, and urban infrastructure solutions. Now, let's talk about what this means for Singaporean investors specifically. ST Engineering is eligible for supplementary retirement scheme investment, which means you can get tax relief on your contributions while building your retirement portfolio. Given Singapore's strategic focus on defense technology and smart nation initiatives, ST Engineering represents a way to invest in the country's long-term strategic priorities while potentially benefiting from global defense spending trends. The company has maintained a consistent dividend policy, demonstrating management's confidence in their ability to generate steady cash flows. This dividend reliability is particularly attractive for income-focused investors and those building retirement portfolios through CPF or SRS schemes. But let's address the elephant in the room. Why is DBS downgrading despite all this positive news? It comes down to valuation and risk-reward dynamics. When a stock runs up 65% in just a few months, you need to ask whether the current price already reflects all the good news that's likely to materialize over the next 12 to 18 months. DBS believes it does. The strong earnings visibility and positive momentum are already baked into the current share price. This doesn't mean ST Engineering is a bad investment. It just means the risk-reward profile has shifted from clearly attractive to more balanced. At current levels, you're paying a premium valuation for a high-quality company with excellent prospects. The question becomes whether you're comfortable paying today's elevated price for tomorrow's expected growth. Here's my take on this situation. ST Engineering is undoubtedly a high-quality company with strong fundamentals and excellent long-term prospects. The global defense spending trend is structural rather than cyclical. Countries aren't going to suddenly stop investing in defense capabilities. If anything, geopolitical tensions suggest this trend will continue accelerating. The company's diversification into digital solutions and smart infrastructure technologies also provides additional growth avenues beyond traditional defense contracts. However, I agree with DBS that the risk-reward equation has become more balanced. The stock has had its moment in the spotlight, and much of the near-term positive catalysts are now reflected in the current price. This doesn't make it a sell recommendation, but it does suggest that new investors might want to wait for a more attractive entry point. For existing shareholders, this presents an interesting decision point. Do you take profits after a 65% run, or do you hold for the long-term structural growth story? The answer depends on your investment horizon and risk tolerance. If you believe in the long-term defense spending thesis and ST Engineering's ability to capture market share in emerging technology areas, holding makes sense. If you're more focused on short-term returns and portfolio rebalancing, taking some profits might be prudent. One risk factor that deserves attention is the potential impact of changing global trade dynamics. ST Engineering has significant international exposure, particularly in markets that could be affected by trade policy shifts. However, the company's diversified geographic presence and strong competitive position in specialized defense technologies should help mitigate these risks. Another consideration is the increasingly competitive landscape in defense technology. While ST Engineering has strong competitive moats in certain segments, the defense and aerospace industry is experiencing rapid technological change. New entrants with disruptive technologies could challenge traditional market leaders. That said, ST Engineering's track record of innovation, strategic partnerships, and continuous investment in research and development positions them well to navigate these challenges. The company's exposure to different end markets also provides both opportunities and risks. While defense spending remains robust globally, economic cycles can affect the commercial aerospace and marine segments. Understanding this cyclical exposure is important for investors considering the stock's long-term prospects. Want to access premium content before they are made available? For just $1 a month, you can become a premium member and unlock a wealth of additional content, including daily market analysis, early insights into promising trends, deeper dives into specific investment strategies, and perspectives that will give you a real edge in growing your wealth. Think of it as your daily dose of financial fuel. Just click on the membership tab to join. Looking ahead, I see ST Engineering as a long-term beneficiary of several important megatrends. Defense modernization programs worldwide, increasing digitalization of infrastructure, rapid urbanization requiring smart city solutions, and the growing need for cybersecurity all play to the company's core strengths. The question is timing and valuation. At current levels, you're essentially paying for perfect execution. Any disappointment in contract wins, execution delays, or external headwinds could lead to significant price volatility. The company's focus on environmental sustainability and governance initiatives also deserves mention. As institutional investors increasingly prioritize ESG factors in their investment decisions, ST Engineering's efforts in developing sustainable technologies and maintaining strong governance standards could provide additional support for the stock over time. From a technical perspective, the stock's rapid ascent has potentially left it vulnerable to profit-taking by short-term traders. Key support levels will be crucial to monitor if the stock experiences any meaningful pullback. The fundamental question is whether the underlying business strength can justify and support the current valuation levels over the medium term. My recommendation aligns closely with the DBS analysis. This is a hold situation for existing shareholders. If you currently own the stock, there's no compelling fundamental reason to sell given the strong business prospects and long-term growth drivers. But if you're looking to initiate a new position, patience might be rewarded with better entry opportunities. Consider waiting for a pullback or using a dollar-cost averaging approach to build your position gradually over time. For those considering ST Engineering as part of their CPF investment scheme allocation, the stock's inclusion makes it accessible for retirement planning purposes. However, given the current elevated valuation, it might be wise to allocate only a modest portion of your CPF funds to this single stock and maintain proper diversification across different sectors and asset classes. The broader lesson here is that great companies don't always make great investments at any price point. ST Engineering is undoubtedly a high-quality company with excellent long-term prospects, but the current valuation leaves very little room for execution errors or external surprises. Sometimes the best investment decision is recognizing when to exercise patience and wait for better, risk-adjusted opportunities. For Singaporean investors specifically, ST Engineering remains a legitimate core holding candidate for long-term portfolios, especially within SRS accounts where you can benefit from tax advantages. Just be mindful of current valuation levels and consider your entry timing carefully. The defense technology spending cycle appears sustainable, and ST Engineering is well positioned to benefit from these trends. The key question is whether you're willing to pay today's premium valuation for tomorrow's expected growth. In conclusion, while DBS's downgrade from buy to hold might seem negative on the surface, it's actually a rational and measured response to the stock's exceptional recent performance. The company's fundamental business remains solid. The long-term outlook stays positive, but the valuation has become stretched relative to near-term catalysts. For existing shareholders, maintaining your position makes sense given the quality of the underlying business. For new investors, patience could be rewarded with more attractive entry opportunities down the road. Remember, successful long-term investing is not just about identifying great companies, but also about timing and valuation discipline. ST Engineering clearly checks the quality box, but the valuation box might need some adjustment before it becomes truly compelling for new money again.